Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Wouter Volkart, manager of the Henderson Global Trust. Hi Wouter.
Hi.
So the Global Trust has a pretty nice dividend at the moment, about 2.8%. But if we take that out of the picture, although investors won't want you to, looking just at the share price, it's been a pretty flat year with some volatility in the middle. What's caused that?
Okay. Currency movements are the biggest driver behind that flat performance. We've got pretty good stocks and we generated a pretty good dividend and we paid out a pretty good dividend yield. But it's been a very strong year for the pounds. And we are a global trust. We're a truly global trust. Over 90% of our assets are invested throughout the world. And therefore, the assets that we have in euros or in emerging market currencies have been a bit weaker this year. I expect that next year that might turn around a bit because, of course, we're going into the so-called Brexit year. We'll have that overhang throughout 2016. So I might see a bit more weakness in the pound and a bit more strength in the euro, for example. And therefore, I think 2016 will be a better year in that regards.
Looking at 2016 and the portfolio makeup, at the moment, about 50% of the portfolio is in the US. Is that an area that you'll be looking to trim from? Because, of course, it has had a stellar run. Dollar is extremely strong. Can we expect more of that going forward?
Yeah. Well, we still like the US because we do have 50% of our capital there. When I look at the world from a top-down perspective, I'm starting to warm up a bit more towards Europe and even some selective emerging markets. And so we've been reallocating a bit of capital. And the reason to like Europe is because it's a cheaper market. The currency has bottomed, or at least we're in the bottoming process. And there's more room for earnings growth because we're starting from a much lower level. Whereas in the US, the market's a bit more expensive. Earnings growth might be a bit more difficult because all the earnings that you import from abroad are imported at lower currencies, and also corporate profit margins are quite high in the US. So from a top-down point of view, there's reasons to allocate a bit more money towards Europe or other parts of the world. However, as a fund manager, we also have to look at the world bottom-up. And bottom-up, I find when I look at Europe, if I want to take advantage of cheap Europe, I have to go for Greek stocks. I have to go for cheap Southern European banks.
And your shareholders may not thank you for that.
That might not necessarily be the way or the area where you want to invest. Defensive stocks are very expensive in Europe. They're 98th percentile, so meaning throughout history it's only 2% times that they've been more expensive. And that's because we haven't had growth in Europe for the past 7 years. So people have been hiding in these safe places. The US is exactly the opposite. We've had a bit of growth over the past years in the US, and people have jumped on board of the very high growth stories, the Netflix of this world, the Amazons, and they've done very well and they're very expensive. And quality and defensive has been ignored a bit. So you can actually pick up some quality stocks for a reasonable price in the US. And that's when I look at the portfolio holistically, I still find quite a few stocks in the US that I'd like to own. And that's why we continue to have quite an exposure there.
You did mention that you will be trimming, though, in order to allocate towards selective emerging markets. Yeah. Which ones are you selecting?
It'd be Asia over Latin America. I was in Brazil 2 weeks ago and things are bad and they're getting worse over there. But in Asia, we're seeing some signs of pickups or improvements in certain sectors. So we're allocating a little bit more capital over there.
Wouter, thank you very much.
You're welcome.
This is Emma Wall for Morningstar. Thank you for watching.